Have you ever wondered if our economy is following a script written 2,000 years ago? What if I told you that the mighty Roman Empire, a civilization that stood for over a millennium, didn't just fall to barbarian hordes, but was brought to its knees by something far more familiar: money problems. This isn't just a history lesson. This is a story about how an empire's financial system crumbled, and it holds urgent, powerful lessons for your own wealth and financial freedom today. Imagine holding a Roman coin, a denarius. In the early days of the empire, this was pure silver, a symbol of stability and power. But as the empire expanded, its expenses ballooned. Endless wars, massive infrastructure projects, and a growing bureaucracy all demanded payment. So, what did the emperors do? They couldn't just raise taxes indefinitely. That would cause riots. Instead, they found a clever, but ultimately disastrous solution. They started printing more money. Of course, they didn't have printing presses. They did something sneakier. They began debasing their currency. They would recall the silver denarii, melt them down, mix in cheaper metals like copper, and then mint more coins than they started with. At first, nobody really noticed. A denarius was still a denarius, right? But with each passing emperor, the silver content plummeted. What was once nearly pure silver became a coin with barely 5% silver, and eventually, just a silver-washed piece of bronze. Think about it. The government was essentially diluting the value of its own money to pay its bills. This massive increase in the money supply, without a corresponding increase in goods and services, led to one thing: runaway inflation. Prices for everyday goods like wheat and olive oil skyrocketed. A soldier's salary, which once comfortably supported a family, could barely buy a loaf of bread. People's life savings, held in these increasingly worthless coins, were wiped out. The economic chaos was immense. Trade broke down because nobody trusted the currency. Farmers stopped bringing their crops to the cities because the money they received was worthless. The rich, who owned land and physical assets, were largely protected. But the middle class and the poor were devastated. This created massive social unrest and instability, weakening the empire from within. When external threats arrived, Rome was already a hollowed-out shell. Its financial foundations rotted away. Sound familiar? A government creating vast amounts of new money, rising prices, and a sense of economic uncertainty? The parallels to our modern world are hard to ignore. So let's fast forward through this timeline of collapse. It began subtly, around 64 AD under Emperor Nero, who first started slightly reducing the silver content in coins. This trend accelerated dramatically during the crisis of the 3rd century, a 50-year period where over 20 emperors rose and fell, each one debasing the currency further to fund their power grabs. By the time Emperor Diocletian came to power in 284 AD, the financial system was in utter chaos. He tried to fix it with price controls, forcing merchants to sell goods at a fixed price, but that just created massive shortages and a thriving black market. You can't fight the laws of economics with decrees. The value of the denarius had been slashed by over 95%. It was a complete financial meltdown, one that crippled the empire for good. This isn't just a fascinating story from the past. It's a playbook of financial traps that are still relevant in 2025. So, what can we, as modern investors and savers, learn from Rome's spectacular failure? I'm going to share 3 crucial lessons that can help you protect and grow your wealth, no matter what happens in the economy. Lesson number 1: understand what real money is. The Romans learned the hard way that when a government can create currency out of thin air, it eventually will, and that currency will lose its value. Your savings can be inflated away. This means we need to think beyond just holding cash. True wealth is not just the number in your bank account, it's your purchasing power. This leads us to think about owning real tangible assets, things that can't be easily printed. This could mean real estate, which provides shelter and rental income, or commodities like gold and silver, which have been recognized as a store of value for thousands of years, long before and long after the Romans. It's about diversifying out of assets that are purely based on government promises and into things with intrinsic, lasting value. The Romans who owned farmland survived the crisis far better than those who hoarded rapidly depreciating coins. Lesson number 2. Avoid the debt spiral. The Roman state fell into a death spiral of debt. They spent more than they earned and paid for it by devaluing their money, which is a form of defaulting on their debt to their own citizens. On a personal level, we can fall into the same trap. High-interest debt, like on credit cards, is a modern form of financial servitude. It eats away at your income and prevents you from building wealth. Just as inflation eroded the savings of Roman citizens, high-interest debt erodes your future earnings. The lesson here is to be ruthless about paying down and avoiding bad debt. Make it your absolute priority. Living within your means isn't just good advice, it's a survival strategy. Building a strong financial foundation means being a net saver and investor, not a perpetual debtor. This is how you build a personal empire that can withstand economic shocks, instead of being a fragile house of cards. And that brings us to the third, and perhaps most important lesson: build productive assets. The wealthiest Romans owned things that produced value: farms that grew food, ships that transported goods, apartment blocks that generated rent. They didn't just have money, they had assets that worked for them. In today's world, this means investing. It means owning a piece of a profitable business through stocks, especially companies that produce things people need regardless of the economy. It means owning real estate that generates rental income. It means building your own business that provides a valuable service. These productive assets are your personal economic engine. They generate cash flow that can outpace inflation and build your wealth over time. While the value of a currency can be destroyed by a government, the value of a well-run business or a well-located piece of property is far more resilient. This is the ultimate path to financial freedom. It's not about getting rich quick. It's about systematically acquiring assets that will support you for the rest of your life. The fall of Rome teaches us that history doesn't repeat itself, but it often rhymes. The principles of sound money, responsible debt management, and investing in productive assets are timeless. By understanding the mistakes of the past, we can make smarter decisions for our future. We can build a financial fortress that protects us from the modern-day equivalents of currency debasement and economic chaos. It's about taking control of what you can control, your own personal economy. Thank you so much for joining me on this deep dive into one of history's greatest economic disasters. I hope these lessons give you a new perspective on how to manage your finances. If you found this valuable, please hit that like button and subscribe to Common Investors for more insights on building wealth and achieving financial freedom. We explore how to navigate today's economy by learning from the past, and I have a question for you. What is your biggest financial fear in today's world? Let me know in the comments below. I'd love to hear your thoughts. Thanks for watching, and I'll see you in the next video.